Hedge funds are absolutely terrified about the new short selling reporting requirements, so much so that they are begging the Securities Exchange Commission for more time. I'm going to explain exactly why this is happening, and UBS, Fidelity, and many other firms right now are in serious hot water. They're getting fined and censured by the Securities Exchange Commission for committing a variety of crimes, also related to short selling and other regulations that they're not following. You can see here UBS needs to pay over $1.1 million for deficient blue sheet data. In case you don't know what blue sheets are, it's basically related to all of the orders and everything that they push through. The article explains it quite nicely. UBS Wealth Management's USA broker-dealer has agreed to a censure and to pay $1.1 million to settle allegations that it submitted inaccurate trading data to regulators over 6 years, ladies and gentlemen, 6 years, according to FINRA. From December 2012 through 2018, UBS submitted approximately 17,000 deficient blue sheet reports that contained inaccurate information on 4.4 million transactions, folks. Think about those are transactions. Each one of those transactions likely has thousands, if not hundreds of thousands, or even millions of shares that are being traded, options that are being traded, and so on. Shorts marked as long. You get the idea. So they misreported customer addresses, trade execution times for accounts, and whether the trades were even solicited or unsolicited. So this is definitely a big problem for UBS. And you can see here that the issues arose when they migrated to a new reporting software that caused certain required fields to be incorrectly populated in their submission due to coding errors. They self-reported the problems and began addressing the coding issues in 2017, and it took them until 2018 to fix the errors. So, of course, they did not admit nor deny, and this comes just a month after Wells Fargo agreed to pay $1.8 million, along with LPL Financial to pay an additional $1.8 million to settle allegations that they filed deficient trade reports, also the blue sheet data. And this is extremely important because a lot of information is held there, including long and short orders and all sorts of other positions. Right here, we have a letter that was released. This was basically leaked. This information should not be available to the public. And it was released to the new acting chair of the Securities Exchange Commission. It was sent, I should say. And they're asking the chair to give them another 6 months in order to meet the new regulations and rules for short selling by hedge funds. These guys, they need more time in order to set up the systems and processes required for compliance with these new reporting standards, because if they have to report now, they would be reporting a large amount of short positions that they do not want to report. They need to shuffle their trades. They need to move a lot of short positions offshore in order to make sure that they don't have to follow these data collection and processing regulations. So you can see here that they're saying, Dear Acting Chair, MFA and AMA are submitting this letter on behalf of our respective members, respectfully requesting you to direct the staff of the SEC to provide assurance that they will not recommend enforcement action to the Commission under the Securities Exchange Act of 1934 if associated members do not comply with reporting requirements set forth in new Rule 13F-2 and related forms. And I'll pull up that new Rule 13F-2 and I'll explain that to you guys as well. I'll give you a quick breakdown of what it is. Hedge funds must report their short positions and their short activity in certain securities. There are new disclosures that are intended to provide market transparency and prevent market manipulation, such as abusive short selling, naked short selling, and the creation of synthetic shares. The rule applies to institutional investment managers that meet certain threshold of assets under management or ownership percentages. The data publication, the SEC would make the aggregate short position data public, right? And of course, you know that these short firms do not want this data to be public because, of course, they're a bunch of criminals. People will see that they're naked shorting companies. People will see that they have a large short interest and that they're mismarking shorts as long. This protects the hedge funds and not the retail investors. This protects the 0.1% and not the 99.9% of retail investors out there. So the goals here are to increase transparency around short selling, help regulators and the public understand the dynamics of short selling and the risks tied to short positions, and prevent abuses like naked short selling. The hedge funds, of course, want more time because it's going to expose their trading strategies, guys. Answer me here. What did you guys vote? Are hedgies fucked? Yes, no, in the A, or proper fucked? Let's take a look. You know what? Here, let's do something funny here. You guys are going to look at this. How cool is that? You guys can just see me basically 1,000 times. This is what I see as I'm streaming with all of you guys here. So this is kind of what the dashboard looks like. You guys can see. So there's kind of a little bit or a lot going on here. But you can see here we asked, are hedgies fucked? And so far we have 271 votes. Let's just see. I'm just going to say, yeah, they're proper fucked. Oh, I can't do that in this one. So I'll have to open up the other screen here. But I'll go ahead and do that anyway, because it is fun. And you know what? I'm just going to go ahead and end it now. I'm going to close the poll. So go ahead and vote if you haven't already voted. And then it will show you guys the results. Yeah, this is the OBS black hole, Captain Awesome. That's right. So I just wanted to give you guys a quick sneak peek. And this is what it looks like with this stupid expensive software. But I'm going to close the poll now. We got 277 voters going once, going twice, gone. All right, let's see what the results of the poll were. Apparently, where'd it go? Let me get this puppy open here. Apparently, the majority of you guys agree that they are proper fucked in the A. And I do tend to agree with that as well. Again, UBS paying $1.1 million in fines for misreporting their blue sheet data is huge. And I'm going to talk to you guys more here about it shortly and about more else. Shut up, guy. So yeah, we have 66% of people say yes, 7% say in the A, 17% proper fucked, and 10% of people would say that it's all good. These hedge funds are fine. It's no problem. But let me show you what ChatGPT says are the cons here. I went ahead and asked, why is this good and why is this bad? And you can see here that the potential market impacts of the Rule 13F-2. What are the pros? Increased transparency, improving market fairness, and helping regulators detect manipulative practices. What else? It could reduce the risk of hidden short selling practices that destabilize markets. And the cons. Public disclosure of short positions, or even in aggregate, even total, could lead to short squeezes, especially in the wake of retail investor movements like AMC. Ladies and gentlemen, even the fucking AI knows it. Even the fucking AI knows what's going on here. All right. And here, just to show you that I'm not like hiding anything, I didn't ask it anything other than, would you like to dig deeper? It asked me. And I said, all I said was new rule 13F-2 for the SEC. And it went out of its way to explain to us an overview and why hedge funds want more time and the potential market impact. And without my prompting it, I just showed you the prompt. All I did was say the rule 13F-2. It comes out and tells us that public disclosure of short positions, even in aggregate, which means in total, could lead to short squeezes, especially in the wake of retail investor movements like those seen with GameStop and AMC. I didn't tell it to say GameStop or AMC, or either one of the stocks. ChatGPT is just well aware that these two equities are some of the most highly shorted equities over the last decade. Greater transparency could dissuade legitimate short selling, which plays a critical role in price discovery and market efficiency. You know what? Let's keep going with this. Tell me more about the reason they may be worried about short squeezes in GameStop and AMC stock. And let's see what ChatGPT's got to say. Since you brought it up, let's go. Hedge funds and institutional investors are concerned about short squeezes like the ones that occurred with GameStop and AMC because increased short selling transparency, as required by Rule 13F-2, the one that they're desperately asking the new SEC chair, acting chair, to give them 6 more months on, could make their positions more vulnerable to public and retail investor action. Here's a detailed explanation. A short squeeze, I think you guys all know, when investors take significant short positions, the stock price unexpectedly rises, forcing short sellers to buy shares at a higher price to cover their positions, amplifying the price increase further. And this squeeze is exacerbated when more short sellers are forced to close their positions to limit losses, creating a vicious cycle of FOMO buying, delta hedging, gamma squeezing, and hedgies getting fucked. Why GME and AMC were targets? High short interest. Both GameStop and AMC had extremely high short interest ratios, meaning a large percentage of the available shares were being sold short by institutions. Retail investors spotted this and realized they could create a short squeeze by collectively buying shares, driving prices up. Retail investors coordinated their buying efforts, often referring to it as a movement against hedge funds and Wall Street. This coordination overwhelmed short sellers, leading to significant losses for hedge funds. GameStop and AMC became symbolic for retail traders who wanted to fight back against perceived market manipulation by institutional investors. Memes, emotional narratives, and the rise of commission-free trading apps like Robinhood amplified participation. Why Rule 13F increases the risk of short squeezes. The new rule requires disclosure of short positions, which can provide the public and retail investors with detailed insights into which stocks are heavily shorted, how much is being shorted by institutions. This transparency makes it easier for retail traders to identify vulnerable stocks, leading to coordinated efforts to trigger squeezes. Here's how. It exposes weak spots. Public data could highlight stocks with unusually high short interest. Retail traders can interpret this as an opportunity to trigger another short squeeze, potentially targeting institutional investors. When investors know hedge funds are heavily shorting a stock, they can deliberately drive up the stock price, forcing funds to cover and exacerbating price increases. Holy shit. That's a lot of detail. Let's go. Let's do it. Let's read it, figure it out. Transparency in short activity effectively gives retail traders a map of hedge funds' vulnerability. Stocks like GameStop and AMC remain symbols of retail power. Any new disclosures showing continued shorting of these stocks could reignite interest among retail traders, potentially creating a self-fulfilling cycle of short squeezes. What's going on, Francine, Queen Bee, Nick? I see all you guys, ladies and gentlemen. Now, how could this hurt hedge funds? During the GameStop short squeeze in early 2021, hedge funds like Melvin Capital lost billions of dollars covering short positions. Of course, you guys know in January 28th of 2021, over 50 equities were made position close only by broker-dealers like Robinhood, Webull, IBKR, Charles Schwab, etc., including the top two were GameStop and AMC, followed shortly thereafter by Silver ETF, SLV, companies like COS, etc., but over 50 different companies, starting with GameStop and AMC. Short squeezes can lead to extreme volatility, destabilizing not just targeted stocks, but potentially the broader market, creating ripple effects against heavily overvalued equities, blue chips that are way too overvalued. Reputational damage. Hedge funds exposed as holding large short positions in popular stocks risk becoming targets for retail traders who view them as enemies of the market, and probably with good reason. The liquidity problems. The forced buying during a squeeze can strain funds' liquidity, especially if they are overleveraged or holding a large concentrated positions. The thing is that a lot of people don't know. Ladies and gentlemen, I'm going to explain something to all the hundreds of you watching this right now. In case you don't know, it is very easy for firms to hide their short interest already. They can use a variety of derivatives like married and divorced calls and puts. These are called options contracts. They can use swaps and futures contracts as well. They can send their positions from their United States firms to their overseas firms based in the Cayman Islands, based in Europe, etc. And now all of a sudden, they don't have to report those firms, those short positions. They can split it amongst their hundreds of shell companies, so where each one can then hold a smaller percentage of that short position through the use of swaps. Because they're using swaps, they no longer are visible to you. You and I cannot see it, and they do not have to report those short positions as short interest of the stock. They can use exchange-traded funds by shorting an exchange-traded fund that holds these underlying assets like AMC and GameStop. Only the ETF shows short interest, not the underlying assets, GameStop and AMC. And I could go on explaining for another 3 hours how they can hide their short interest. But the fact that they're pushing against this rule and begging the SEC, please do not enforce actions through the new Rule 13F-2. We're fucking desperate. As you can see, this was dated January 20th, 2025. They're fucking desperate. It's because stocks like GameStop and AMC have a massive risk to these guys. They are a massive risk, I should say. Both stocks have loyal retail followings, often referred to as diamond hands investors, who are committed to holding and driving up the price. Any indication of a large short position could reignite interest, and that remains high without reigniting interest, because we know, due to recent disclosures from AMC Theaters, that there are over 4 million retail investors holding over 90% of all shares of AMC stock in existence. 90% of all shares that should be in existence are being held by retail investors. GameStop's not far behind, especially since GameStop has a lot of shares that are DRS'd. I personally don't DRS any shares, and I do believe that any shares that are DRS'd are not able to be sold with any relative ease during market volatility or short squeezes, but that's not the point here. The point is that shares that are DRS'd are basically being taken out of the market and held to the side, in which they can't be utilized in the same way that non-DRS shares can be. So most people don't DRS the shares that they plan to make a profit off of. Most people that DRS their shares expect those to be locked up in perpetuity. There's an ongoing short interest. Both stocks still maintain relatively high short interest compared to other stocks, keeping them on the radar for retail investors looking for the next squeeze. And the transparency here of the Rule 13F-2, which these hedge funds are oh so desperately begging the acting chair Ueda to basically ignore, will make it possible for retail traders to track that the naked shorts and the short positions of these firms, essentially broadcasting which stocks are vulnerable to another squeeze. These guys hide their short interest so they can profit off of you. The stock prices of GameStop and AMC are artificially low at this very moment because of the shorting that occurs. It is not due to anything that the CEOs of the companies are currently doing, because both of them, Ryan Cohen of GameStop and Adam Aron of AMC, have helped pay off tons and tons of debt. GameStop at this point is completely debt-free. AMC stock at this point has paid off over $2 billion of debt and has whittled the remaining debt down to under $4 billion, and has gotten loans extended through 2030 from their creditors, because they understand that with the company increasing their profitability, there is very little chance of bankruptcy for it now. But again, both stocks are artificially manipulated to the downside by hedge funds and market makers that control the price of securities to where they see fit. That is a quote from Kenneth Cordell Bedpost Griffin, who says that we control the price of securities to where we want them to be. Those are Kenneth Griffin's words of the market maker and hedge fund Citadel, two different companies. The broader implications here, folks. Real quick, Tanel Perind asks, boss, why can the daily price change reach out to the thousandth of a penny when the price is moving up but never down? That's not necessarily the case. The thing about the thousandth of a penny, that is only applicable to stocks under $5 a share. So if people, you want to know one of many reasons why they want to keep AMC stock under $5 a share, that is because they get to add extra digits after the decimal in order to chop it up a little bit more and create more fractional shares, to create to make it easier for them to spoof the prices and commit wash trades. Hedge funds rely on confidentiality to execute complex trading strategies, like naked shorting illegally. Publicly disclosing their short positions could hinder their ability to operate effectively. The rise of retail investor activism, that's all of you watching right now, combined with increased transparency, reduces the asymmetric information advantage that hedge funds have traditionally enjoyed. Meaning, with this new regulation, they will no longer be able to have more information than you. Well, of course, they still will, but not to the extent that they currently do. So, hedgies don't want that to happen, right? Increased cost. Hedge funds may need to spend more on legal and compliance measures to adapt to the new reporting requirements, while also defending against potential squeezes. Well, maybe you shouldn't have naked shorted the companies so fucking much. I have absolutely zero empathy for those hedge funds that are out there manipulating markets. Nothing wrong with a hedge fund or family office if they're making money in legal ways. But if they're out there manipulating markets, issuing bots and other people to commit short and distort campaigns, paying companies like MarketWatch and MarketBeat to put out false information, I have no empathy for them whatsoever, nor their bankruptcy, like Melvin Capitals and many others that have gone bankrupt. So the conclusion here is that Rule 13F-2 is a well-intentioned attempt to bring transparency to short selling, but it inadvertently exposes hedge funds to retail-driven short squeezes, particularly in stocks like GameStop and AMC. These risks explain why hedge funds are concerned about the rule and lobbying for additional time to prepare. And I would add, to break up, chop and screw all of their positions amongst all of their subsidiaries offshore and hide them within various derivatives and ISDA contracts, so that we won't be able to see the actual short interest. So as of now, they have not done so. And because they have not properly reported it, they are asking the new acting chair, Mark Ueda of the Securities Exchange Commission, to provide assurance that the Securities Exchange Commission will not recommend enforcement action to the Commission under the SEC Act of 1934, the Exchange Act, because these association members will not comply with the reporting requirements set forth in the new rule. So, ladies and gentlemen, I think I've made my point. Ernest, that rule is now into effect. That rule is effective already. So, effective January 20th, that rule is in play, Rule 13F 2. And again, I went ahead and I asked ChatGPT, and yeah, I'll give you a quick thumbs up and I'll say, thanks, GPT. Says, you're welcome. You know what? Let's see. Tell my friends here on the Butcher of Wall Street YouTube channel, as we're live right now, live streaming right now, 20 different ways that these firms can hide their short interest. Got it. How easy is it, ladies and gentlemen? How easy is it to get information nowadays? I used to spend hundreds and hundreds of hours to figure out this information. Now I've learned it, so I don't need to do it. But now instead of going to 48 different websites to figure it out, I can ask ChatGPT and then just go in and verify after the fact to make sure that the information is correct. I'm not going to give you all of them in detail. I'm just going to read them off. 1 through 20. Ready? Number 1. Off-balance sheet entities. What the fuck did I just get done saying? I literally just got done explaining this to you guys. Using subsidiaries or other entities to hide short positions, keeping the main's firm balance sheet cleaner. They can chop and screw it and spread 20% short interest into 20 different firms, so they each hold 1% short interest times 20. Of course, it's the same 20%. They do so within swaps and derivatives. Therefore, you can't see it because they're over-the-counter transactions where JP Morgan can hold a short position for Virtue Financial, for example, if they wanted to. And then nobody can see that they're actually shorting it. It's only a 1% short interest in Virtue and 19% in their additional firms. Now you have no reporting required. Private transactions. Number 3, puts and derivatives. Shorting through exchange-traded funds. Creating synthetic short positions through credit default swaps or other derivative contracts. Borrowing stock from non-reporting institutions. Naked short selling. Short selling in foreign markets. Using SPVs. Cross-border swaps. Hedge fund group collusion. Non-public short interest data. Brokers acting as intermediaries. FTX and Bittrex. Ring a bell, anybody? Rehypothecations. Borrowing from retail investors. That's right, ladies and gentlemen. Your margin accounts are being lent out. Your shares in your margin accounts are being lent out without your approval because it's not needed if you have a margin account. And also through non-disclosed lending programs, which are often happen in a lot of these scumbag brokerages. Avoiding the short interest reports in formal markets because it's all self-reported. Debt financing. Delaying disclosure, which is exactly what they're doing right now, right? Dark pool trading. Engaging in dark pools where the buying transactions in dark pools where the buying and selling of shares are done off exchange makes it hard for outsiders to track short interest. Derivative contracts with custom terms and shorting via long/short funds. And they said these are just some of the more creative or complex strategies firms might use to obscure their short interest and evade full transparency. They take advantage of regulatory gaps, blah, 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 blah. Yeah, hey, got 20 more? What has it got to say? Of course, here are 20 more ways hedge funds and other institutions might hide or obscure their short interest. Share these with your friends on the live stream, Butcher Wall Street. Grandpa Barney. Hey, welcome back, Grandpa Barney. I haven't seen you in forever, my friend. By the way, thanks for the super chat, my brother. You didn't have to super chat me, but it's very kind of you, and thank you for supporting the channel. He says, I'm still buying and never stopped on sitting on a crap ton of shares, is what he's saying. Not leaving. Give me my effing money, says Grandpa Barney. Cheers, my friends. I'm right there holding with you guys. You guys have seen me take 6-figure positions in these companies here on the live streams, and I'm still holding those shares. And I've also, of course, continued to buy options contracts call contracts specifically. I have not bought any puts on AMC or GameStop in any way, only call contracts and shares. But again, they gave us 20 more ways. 20 more ways. And I'm not even going to read them. I'm just going to go through them and just give you guys an idea. Look at how easy it is. Just like that, there's more and more and more different ways that these guys can commit to hiding their short positions. And of course, look, one of their favorites, market making and OTC derivatives. Acting as a market maker in the OTC market over the counter allows the firms to gain short exposure without formal reporting requirements associated with listed securities. There could very well be 300% short interest in GameStop right now, 300% short interest in AMC right now, and nobody would know until they got short squeezed. So the key takeaway: they employ a combination of creative financial engineering, off-market arrangements, and complex strategies to hide their short positions. Man, I'm just going to sell. Good work, GPT. Thanks. All right. I think I've had enough fun with ChatGPT for now. And we see what's going on here. We see that UBS is proper fucked. These hedge funds are proper fucked. And they're the ones that bought up Credit Suisse, the same company that went insolvent and bankrupt due to their short positions that were absorbed from the crash of Archegos Capital. And that family office, of course, you guys know that Bill Hwang of Archegos Capital is now in prison for the rest of his life for the over-leveraging that they did and the crimes that they committed. Now, it's not just that. In case you guys wanted to know, the Japan carry trade still has massive risks against the market. I will read that here later. But for now, FINRA has also fined, they're not the only ones. UBS isn't the only ones getting screwed. Wall Street Access for alleged rule violations. Wall Street Access has agreed to pay a fine because between April 2019 and 2021, they violated the regulation NMS, National Market System of the SEC Act of 1934, the same one that these guys are begging the SEC not to prosecute them for, the new Rule 13F-2, by failing to take reasonable steps to establish that their intermarket sweep orders are routed to certain market centers and meet the requirements for the sweep orders. I could explain what that means, but in reality, they're committing crimes. They're not following the NMS rules, and they are artificially manipulating markets. Fidelity Brokerage Service has been fined $600,000 by FINRA and have agreed to pay it because through an affiliate who provides record-keeping services for their equity compensation plans through stock plan services, accounts for their domestic and international employees for over 8 years, they were not designed to supervise that person's access to the account data or the transmittal of funds. What do you think that means, ladies and gentlemen? Well, it means that they had unregulated access, unfettered access to private information. And they converted data for approximately $750,000 from over 37 international plan participants. FINRA has violated Fidelity has violated a variety of FINRA rules here. And these brokerages just never continue to astound me. And look, Bank of America, B of A Securities, to be exact. Ernest, I will answer that. How will Japan rate hikes affect the U.S., boss? I will definitely answer that here shortly, my friend. Last one. Bank of America has been fined $250K for not reporting 5,200 transactions to the compliance engine on time in violation of a variety of FINRA rules. From 2018 through 2022, they failed to include the modifiers on over 57,000 reports to the compliance engine in violation of FINRA rules. And of course, they get a slap on the wrist in the form of a $250,000 fine and consent to the imposition of a censure. Basically meaning, you guys can continue to do business. Here's your slap on the wrist. Give us some money. It'll be our little bribe, and you guys can go on your way. That's exactly what it means. And I will say, I'm just as tired of these brokerages as anybody else. And if you are as well, you need to look into Lit Exchange. Period. I'm not going to give you guys a lot of information on it right now. You can go look it up for yourself if you want. But the fact of the matter is that Lit Exchange is an upcoming stock and crypto brokerage that has raised over $500,000 from nearly 300 retail investors. And we have done this 100% organically. Not a single dime has been spent on advertising because people are tired of the bullshit. They are ready for a company that does not route all of their orders to wholesalers and dark pools to be front run and manipulated. Lit Exchange aims to automatically route orders to lit markets to prevent and deter manipulation of your trades that occur every single day via payment for order flow and dark pools. So you can get a lot more information about the company, or see our SEC filings on the Securities Exchange Commission Edgar website, as well as see the FINRA regulated funding portal, Silicon Prairie. That's on the right here. That's what you're seeing here, in which you can invest in the company in Series A non-voting membership interest, which basically means when we IPO, you get shares of the company at the current price, not at the IPO price. You will then be able to sell it at the IPO price and potentially make a shitload of money. The interface is fucking phenomenal. I will say that we've been working on it with our engineering team and our developers for many, many months. And we were just literally working on that right before I started this stream. That's why I was a little bit late. It's fucking awesome. I have not seen any other brokerage, because I've used dozens of brokerage over the last 20 plus years. And I've been using them as a benchmark of just to see how shitty they are. I've not seen any other brokerage that's doing what we're doing, and that's extremely exciting. And we're definitely very, very ready for the launch. Let's put it that way. We're ready to launch. You can see everything on the SEC Edgar website as well. You can also type in Lit Exchange LLC SEC Edgar, and it'll pop up. But you can get there directly from our website to the SEC Edgar website and view our various filings if you need more information. Hey, Paul Andrew says, FYI, if anyone signed up for Lit Exchange, they should check their spam folders. I learned that yesterday. Hey, thanks for the heads up, my friend. Yeah, the emails from Lit Exchange funding portal and from the website sometimes get caught up in spam folders. So yes, you should most definitely, just trying to see why this isn't opening, should most definitely check up your spam folder, because sometimes they come from WordPress for updates, for email updates from me. Other times they come directly from the funding portal, which is Silicon Prairie. Bank of America, $250,000 fine. Fidelity, $600,000 fine. Wall Street Access, what did they get? What kind of slap on the wrist they got? They got a $125,000 fine. Hedges are so fucked. UBS, $1.1 million fine. Hey, sweetie, you all right? You okay? All right. My little one was just getting over a cold right now, so she stayed home from school today. Just want to make sure she's good. But check this out. The market is at very high levels right now, right? Johnny Bleed, a good interface is important. Can't wait to see it. Cheers, my friend. AP, can an international regard invest in Lit Exchange? Yes, my friend. We have a lot of investors from Canada, Switzerland, Denmark, Germany, the UK, Ireland, like the whole 9 yards. We have investors from all around the world, and we haven't even started to advertise it. Drink some water, baby girl. Go to the fridge, then. Is mommy down there with you? Baby girl, you know where to get water. You got her, sweetie? Thank you. Go by Lil. Thanks, honey. She's going to be just fine, thank God. Omar Lopez says, at the end of the day, nobody's going to do shit about it. Just another slap on the wrist. And I agree with you, my friend. That's why we're creating a lit exchange. Should I say a brokerage called Lit Exchange? Because we're going to route your orders to the lit markets, to the lit exchanges. That way they can't get front run. They can't get manipulated in dark pools. They can't be wrongfully reported. Get it? None of these firms are going to stop doing what they're doing. So we have to literally create our own firms on Wall Street to stop them by taking control of our own fucking orders. It's just that simple. It's a very complicated, expensive, long-term endeavor, but here we hope to launch here at the end of this year. That's the plan. Peter says, yep, Denmark here, already invested. Cheers, Peter. Much love, my friend. Appreciate you, and I'm glad to have you as a partner in Lit Exchange. Black Widow Transparency, another partner in Lit Exchange. Thank you, my friend. I know there's quite a few of you guys out in here, and ladies as well. Japan plans interest rate hike while monitoring yen carry liquidation risks. And one thing that gets me is that a lot of people think that this is already priced in. Yeah, to an extent. To an extent, this is already priced in. As expectations rise that the BOJ will raise interest rates at the monetary policy meeting this week, which is this week, attention is focusing on the possibility of a reoccurrence of the yen carry liquidation that triggered last August's Black Monday incident. Experts project that, unlike last year, the scale of additional liquidation will not be large due to the continued strength of the dollar, yet they remain vigilant. Now, they're kind of flip-flopping here. They're saying that indicating that the economy and the price outlook align with expectations, increasing the possibility of a rate hike. If the Bank of Japan raises interest rates, it will be the first increase in 6 months since they raised it from 0 to 0.25. Here's another very important thing. When the Bank of Japan raised interest rates in August of last year, they didn't do it a lot. They raised it from 0 to 0.25. to a quarter of 1 basis point, guys. Sorry, not a quarter of one, like 25 basis points, a quarter of 1% here. A ridiculously small amounts that they raised it. And the benchmark rate is expected to be 0.5%. So this will be the third interest rate hike since the termination of negative interest rates in March of last year. And I got to correct myself. They went from 0 to 0.1%, and then from 0.1 to 0.15, and then from that to 0.25. And that little 0.1% bump was the third time that they raised rates, and that had the Japan carry trade to unwind a shitload of derivatives because of the discrepancy between the DXY and the Japanese yen. So they said, the last time the BOJ raised interest rates, a global stock market crash occurred. This was due to the expectation of interest rate cuts. I'll zoom in a little bit for you guys so you can see a little bit better. In case you're watching, you can listen, of course, just in case you want to read along. And of course, this narrowed the interest rate gap between the US and Japan. This led to a liquidation of the yen carry trade, where low interest rate yen was borrowed to invest in high interest currencies like the dollar. However, the US economy proved to be solid. The carry liquidation movement has subsided for now. So if the US economy starts to look worse, or if the Bank of Japan raises interest rates more than expected, we could see this happen again. If the BOJ raises rates, the carry trade liquidation, which had taken a breather, could resume. According to the CFTC, recorded a net selling of 29.4 thousand contracts as of the 18th of January, considering that it turned the net buying in August of last year and led to a significant liquidation of that carry trade. The scale may have expanded again. Some analysts suggest that up to $34 billion worth was the fund balance of the carry trade as of March of last year. And the Bank of Korea analyzed that about 6.5% of that could be liquidated. So we're looking at, several $billion could easily be liquidated, which would affect other trades around the market. And they believe that this is going to be different So the likelihood of the carry trade liquidation is not very high, but noted that, quote, the emergence of the liquidation in August last year was due to Japan raising rates contrary to market expectations, while discussions on interest rate cuts were happening in the U.S. Currently, concerns over a strong dollar are increasing, making carry liquidation unlikely. This indicates that maintaining the high dollar value reduces the incentive to sell dollars and buy yen. So they further on said they're talking about former Prime Minister Abe. During the Abenomics era, more than half of Japan's external assets were concentrated in stocks and bonds, but now they're focused in foreign investment, direct investment. So there's not many assets to be liquidated right there. Again, just $34 billion, measly dollars here. So he said, even if there's no interest rate hike, I believe we reached a point where the Trump trade could revert. Obviously, not very good for markets if that does happen. Let me just get out of this page already, since it's having trouble with the translation. So again, it could be nothing, or it could be something unexpected. If the interest rates are raised more in Japan than expected, or if the United States dollar falls more than expected, or if the U.S. economy begins to falter and show a true recession, the carry trade could unwind very, very quickly, leading to a fire sale of blue chip assets all around the world and multiple markets. So I just wanted to bring that to your attention because that is a possibility this week. And I think that everybody needs to be aware that I do believe that markets will keep rip-roaring higher for the very short, very, very short term. However, in the near future, something like the carry trade could come along and wipe away all of the gains that people are seeing. Rob Carey Hunt says, how much does it cost to become a founding member of Lit Exchange? My friend, you can go to the Lit Exchange website and check it out there on the funding portal as well. But is an investment in the company again. So there are a variety of tiers, and the starting tier for investments in the price per unit is $500. Now that is not a share. You're receiving a unit of the company, at which point when we IPO, as we plan to do in the future, you will then receive, many thousands, if not tens of thousands of shares for your one $500 investment unit. And for every $500 thereafter, so say you invest $1,000, obviously you would get 2 units because the price per unit is 500. So you'd receive significantly more shares as well. And right there on that same website, it's linked in the description down below, and over here on the side, right there, you'll see it in the chat. You'll see the pitch deck, the business plan, the independent auditor's report, offering memorandum, the Securities Exchange Commission filings, the investment disclosures. Everything is on there, along with a lot more information about the company. And in the full pitch deck, towards the end of the pitch deck, you can see what you get in the offering. We got, different levels: Moonwalker, Silverback, Apex Legend, Juggernaut, Interstellar, Gamma Squeezer, Deep Fucking Value Investor, and so on. And so you get a lot of things there, and investments are cumulative. So if you decide to invest $500 now and $500 in a couple of months, whatever, when you get your taxes, whatever, then you would receive the $1,000 tier of investments. And of course, that comes with a lot of different perks there as well. Not just the most expensive one. They all have a significant number of perks. For example, real copper coins, real 999 silver coins that are being minted, one of a kind, and a one-time run for the creation of Lit Exchange that will never, basically it'll be a collector coin made out of real 999 silver that'll never be made again. So in the future, they could potentially be worth way more than 1 ounce of silver because it's directly related to the company and it is a one-time limited run. We're going to be giving people, things like hoodies and many months or even years of free level 2 data and subscription services, discounts on trades, stock trades, early access to new investment opportunities, projects, first buyer's rights of additional stock prior to our IPO on the NYSE, an equity share percentage of ownership, etc. And, obviously that goes up. You get 18 months of of trade discounts, 3 years, 36 months of free level 2 data, 50% discount on stock trades for 36 months, framed wall art, signed things, and so on. Priority service with customer service and phone service when you call. Just a whole bunch of different things that we're offering to really give people a large amount of interest. So not only are you getting the equity share ownership percentage of the company, which you can then sell when we IPO, say you get, let's just use a number. I'm going to throw out a random number. Say you're going to get 10,000 shares for every $500. If you get, if you invest $1,000 worth, you get 10,000 times two, et cetera. But you don't get shares right now. Right now you are investing in the units of the company, $500 per unit. And you can get as much as you want, as long as based on the limitations by the Securities Exchange Commission and their regulations through the Jobs Act, which is all handled through the FINRA regulated funding portal and brokered through their called Silicon Prairie. They are the ones that hold the money in escrow. We have not taken a single penny of this $500,000 that we have raised. It is in there. It has not been spent, and it is accumulating here. And we will put that money to good work here in the very, very near future, as we are going to use it to launch the company here. We plan to do that later this year, my friends. But this is a once in a lifetime opportunity. This has never been done by any stock or crypto brokerage in the history of the world. This is the first company in the history of the world that is giving retail investors, not accredited retail investors such as yourselves, the chance to actually own equity in this company before we launch and before we IPO. So keep that in mind. Peter, can I buy more units before we IPO? You can buy more units only while this Regulation CF campaign is happening. When we meet our goal, it will be closed, or when we reach, August, whichever happens first, you will not be able to invest after that. So in a few months from now, or whenever this reaches our goal, you will then no longer be able to buy more shares at the current prices, because this is a seed round, basically. You're investing in the seed round of Lit Exchange before the company launches and IPOs. Therefore, you're getting in on the ground floor. So when we IPO at a significantly higher price with many, many thousands or hundreds of thousands or even millions of users, and the company will achieve a much, much higher market capitalization, there is a significant potential for profits there. Now, of course, there's always risk involved in any investment, but I will say that all of the risk is outlined. All of the foreseeable risks are outlined in our disclosures, as there would be with any company. And my partner and I each have over 20 years experience in scaling and building multi-million dollar companies of our own with zero outside investment. This is the first time that I have ever, and my partner has ever, built a company in which we are reaching out to, whether it be venture capital firms or retail investors, for the purposes of raising external funds. And we're doing this because in order to start a stock brokerage firm, we have to have 12 months of expenses in order to receive our FINRA regulatory approvals. And we are well on our way there with over $500,000 already. All right. Ladies and gentlemen, I wish you peace and wealth. I think we'll leave it at that. It's been a whole lot of fun. The reverse repo is falling apart. The liquidity in that market is just almost non-existent nowadays. It's under $100 billion, basically. And the Treasury general account is going to get drained pretty soon. Little by little, it's going to start getting chipped away. So do make a smart investment with your tax returns this year. Make a smart investment, invest in your future, and make sure you're properly hedged, ladies and gentlemen. Cheers. I'll see you guys tomorrow for another one. Thanks again, ladies and gentlemen. Appreciate all of you, and Lit Exchange investors, founding members very much as well. Looking forward to launch.